The New York Stock Exchange tried to find its footing this past week after its roller coaster week of correction last week. While stocks tried to recoup some of their huge losses, there were new financial reports that had an impact on investors. Everything from the consumer price index to weaker sales for big ticket items like cars and a decline in the purchase of other products. Well, Rick Applegate is back with us this morning on the Sunday Business Page. He's a regular contributor to the Money Talk segment of News Radio 1020, KDKA's Morning News. And Rick knows everything. So, hey, it's always great to have you on the show. John. And I have to say, I think Wall Street is nuts. I think they're crazy. The economy is doing fine. Yep. They get a report that wages are going up. And instead of treating that as good news, which it is for everybody, it's bad news. You know, and then they do all this dip and whatever.
Absolutely. And we've been talking, you and I together, I've been reporting on Money Talk forever, about the need for American workers to get more pay. Right. So they get more pay and the market reacts the way it did. It was the largest increase in hourly wages reported in January, 2.9% that we've seen since 2009. Right. But when you think about the fact that inflation, John, in this country, which was also just reported, has averaged just under 2% on a core inflation basis. Right. That means workers are just barely still staying ahead of inflation.
Right. So what's and after years of not getting anything.
Exactly. So what, as you say, is why the overreaction? I think that a lot of it had to do with a long overdue pullback in the market. And it was expected. It was just far too complacent. Volatility was far too low. There was a need for things to get back to, quote, more normal. And that's what it did.
So the market drops 10 points, and then it climbs back up, at least 5 points back up. And I don't know, who knows where it'll be in the next month or so. Right. But we could be back up to where we were at the beginning, of February.
Yeah, and I think that what we're really starting to see that is important for investors out there to be aware of is a disconnect between everything rising together, i.e. the fixed income bond market and stocks were just kind of working in tangent. But now there's a disconnect that's happening. And stocks, which went down substantially as that inflation fear spiked, is now recovering and going back on its own. But the bond market is going in a different way. When interest rates go up, as we know, bond prices go down. Right. So we have a 10-year note now approaching 2.9%. And my concern to this complacency that might resurrect itself with the stock market going back up is that when the 10-year note crosses 3% and keeps on moving, investors start to look at that and say, why am I taking risk with stocks? I'll just go get that nice, secure yield from that treasury. More volatility is going to resurrect itself in the stock market.
So for the average investor out there, and I'm thinking of mostly us who have 401ks and IRAs, what are we supposed to do? Just kind of ride this all out because it's... we have no control over it anyways?
Yeah, I think the thing, John, that's real interesting about that couple of 1,000-point drop that happened in the stock market is the focus that many investors, 401k investors, for example, have on what happened with the Dow, what happened with the S&P. Anybody out there who has 100% in one of those indexes, yes, they went down a couple thousand points. And the lesson here is diversify. Right. If you had money, foreign stocks, U.S. stocks, large cap, mid cap, small cap, bonds, government, you're fine. Your adjustment maybe wasn't even 1%. So look to the time period that you have to invest. Be sure to diversify appropriately. Don't be overexposed. You'll be fine in the long term.
That's always good advice.
It is.
And so the bottom line is if you think you're allocated correctly, just sit back and relax.
That's right. Don't overreact. That's the one thing people do all the time when these kinds of one-off events occur is overreact, sell out, get out of the way. Big mistake because they're going to miss the upside as they did probably last week.
So what's your prediction? We've got a minute or so left. As we go forward in 2018, just more of the same, or do you think the market could reach new high levels?
It could, but I think we're back to a more normalized event here. I think the things that are going to happen, John, is that what the stock market was pushing against versus going down was the fact that the economy, in fact, is pretty good, and earnings have been very strong. And you have a tax policy in the winds coming of corporate ownership stocks. So I think that, in fact, it's going to raise the stock market again. But as I just said, I think there's going to be competition coming from the higher yields of bonds. So I think it's going to waffle some more throughout this year, i.e. a more normal market than we've seen for quite some time.
But in the end, will 2018 be positive? in the stock market?
You know, I think it will be. I don't think it's going to be the knock the socks off 19% return that we saw last year in the S&P.
Right.
But I do think it's going to be single digits. I'd like to estimate that we're thinking somewhere around, let's call it 7 to 8.
Right.
And if it's not that, don't call me.
You know, as long as it's better than inflation.
Yeah.
Then we really have nothing to complain about.
No,
We're making money.
Well, that's the point right there, John, is keeping money real. Stay ahead of inflation. If inflation's 2%, you want to outperform it. So you only need 4 or 5%, let's say, after tax, you're fine.
Rick Applegate, you always make it so easy to understand.
It's always good
Even
to see
though I
you.
find this thing really wacky. I still think the market's
Thank
crazy.
you. My pleasure.
Great to have you on the show.
Thank you, sir.
We'll be back with more of the Sunday Business Page in just a few moments. Stick with us.